Good afternoon, everyone, and thank you for joining today's edition of New York MBA's Affordable Fridays webinar series. On behalf of our president, Jeff Pinard, we thank you for joining us. And we also have Brian Garris and Sherry Eccles, co-chairs of the Affordable Housing Committee. The focus of this committee is to educate lenders and provide additional resources that opens more doors to homeownership for New Yorkers. Before we get started, I'll just review a few housekeeping notes. If you experience any difficulties, don't worry, we have a dedicated tech support team ready to assist you. Just use the chat function to notify us. During today's webinar, all lines are muted except for our presenters. Throughout the session, you'll have the opportunity to ask questions. Please use the chat box or Q&A to ask the questions, and we'll do our best to address as many as we can at the end of the session. We'll be recording today's webinar and sharing presentation slides and relevant resources with all attendees after the webinar. I'm happy to welcome to the New York MBA, Joe Culver, as the new executive director of the association, who is also today's guest speaker. At New York MBA, we want you to stay connected and hear about industry updates and all that New York MBA is doing by following us on social media. You'll find us on LinkedIn, on our website at NYMBA.org, and on YouTube, where we post recordings of our webinars. Now I'll turn the program over to Sherry Eccles, who co-chairs the Legislative Committee, to talk briefly about the upcoming advocacy conference. Sherry?
Great. There we go. Perfect. Hi, everybody. Thank you so much for joining us. Happy Friday. And so we have an advocacy conference coming up March 11th and 12th. Wanted to give you just a little overview of what that looks like. The first day we will meet usually there's a legislator or two that will come and speak. And then we spend the afternoon educating the members on the various bills and legislative priorities that we have. I am going to speak to some of this stuff after Joe's presentation today, if you'd like to stay tuned at the end. There are some pretty critical things that we're trying to get accomplished in terms of increasing access to homeownership in New York State, as well as some bills that we see as extremely detrimental to the future of the housing supply in this state that we are very adamantly opposed to. And there's a lot of strength in numbers, so we're really trying to encourage attendance as much as possible. Next. And if you are able to attend, obviously sponsorship is really helpful in terms of helping make the event successful. The night in between our education day on Monday and the actual March on the Hill on Tuesday, we do a cocktail reception at the Fort Orange Club that's attended by a lot of legislators. So it's great to be able to speak to them directly in a more intimate setting and a little bit less formal, obviously, than the meetings that are in their offices. And just a little bit more information on what the actual advocacy day looks like. We will prepare you. There will be materials that you can use with talking points, and they also can be left behind. And once we get people registered, we reach out and schedule meetings with as many of each member's individual representatives as we possibly can. You will not be on your own for any meetings. You'll be paired with several other folks. So you'll go with a group of 3 or 4, and you'll usually meet with 3 or 4 different legislators. So it's great. We try to prioritize, again, people's actual representatives, as well as there might be some people that are members of the banking committee or other committees that have relevant legislation in front of them that we'll also try to get in front of. So I encourage your participation and the sponsorship of your companies to help make it a really successful event. There is a lot on the line in terms of what's out there legislatively, which we will talk about later. And an easy way to get involved now is by joining the Mortgage Action Alliance. The link is in the slide deck. So anybody who's interested in getting the slides, let us know. But you can also Google Mortgage Action Alliance, and it's pretty easy to sign up. You just really have to give them your name and your email address. And what that does is gets you connected with the NBA, who send out notifications of pending legislations as well as calls to action, and information on how to act in terms of, what link do you click on, who do you need to be contacting about specific bills, and why does it matter to us in the industry. So obviously, again, there's strength in numbers. Being able to speak to that there are 150,000 mortgage professionals nationwide registered with the Mortgage Action Alliance is a powerful thing to be able to say. So the more people we get signed up, the better. And with that, I will turn it over to Brian Garris, who's going to introduce our speaker for today.
Thank you, Sherry. Excellent. One other quick thing on the registration for the advocacy. The sooner the better. Sooner you get your registrations in, the more effective we are able to set those meetings with legislators in your districts. And that's all I'll say about that. So keep that in mind. And when you get the invitation, please pay attention to that one. It's very important. So without further ado, I am thrilled to bring to this Affordable Friday series the famous Joe Culver. He's our guest speaker today. He's going to be reviewing the Habitat for Humanity loan program for lenders that was set up by the NYMBA a number of years ago. So if you don't know Joe, he's probably one of the nicest, most educated, well-rounded lenders that I can think of. I have a lot of respect for him. And he's a founding member, past president of the New York MBA, founding member. He has 40 years as a senior manager in the mortgage banking industry and is just retired, in fact, in December after the past 18 years with NBT Bank. He's also one of the creators of the Habitat for Humanity program guidelines, which we'll now dive into. And so Sherry's going to be moderating some questions. Please use the chat or the Q&A on your screen, and turn it over to Joe. Thank you.
Sure. Thanks, Brian. Appreciate that. Just making sure everybody can hear me, right?
Yep.
Excellent. And Christina, if you could you click on so we can see the slide full screen? If that's possible.
Sure. I thought that's what we were doing. One moment.
Sure. So while Christina is doing that, the one of the key things here that we wanted to, just kind of set the stage. As you see there, we've got the header on each of these slides here: Habitat for Humanity, the New York MBA loan product guidelines. So that's the first real key to this is, this is not our own product. We worked in conjunction with several board members at the time back in 2017, along with a couple of other lenders that were also on our board of directors. We wanted to create guidelines that then any lender in New York State or who does business in New York State could certainly then take these and create your own specific product, right? And whether you call it Habitat for Humanity or Portfolio Habitat, that's certainly up to you. So I just wanted to have that disclaimer out there first that, there's no rights of ownership with this. What we simply wanted to do was take all of our expertise, all the expertise that we had in working with the various chapters, and at that time, the CEO of Habitat for Humanity in New York, and then just put together all of these guidelines that any lender can take. And again, just pop it into your own box, make any tweaks that you certainly want based on, your lending criteria, based on your chief lending officer and what they look for with any residential loan products that you offer. So that's the context behind this. So again, we're going to give you the overview, show you the guidelines and kind of how we think it should be set up so that you're addressing all of the real key components, which is important, A, and then B, when you create the final product, we know it's extremely important when you then share that product with both your sales staff and your operations staff, and you walk them through it, that everybody knows what it is. They can follow the guidelines. They can refer back to it. And you're really making the type of loans that you really want in your portfolio, which is what's great. So again, the basic reason as we got deep into this, it came as a result of a lot of the changes that were happening throughout the industry. As all of you know, as lenders, right? Everyone now either has to be registered with an NMLS number, or you have to be licensed, right? Depending on if you work for a bank, a regulatory institution, if you work as an IMB, you've got that criteria that's set up. And one of the things that was interesting, and it just went on for many, many years, was that, regulation was not taken down to the next level, meaning, you look at an international organization like Habitat for Humanity, right? That lends and has these chapters all around the world. That was not brought into their world. They were not under any guidance that stated, that they had to have anyone in their organization who was providing the financial information to be either registered or licensed with an MLS number. So for years, chapters had been offering their own product and offering financial advice, and basically putting people through the mortgage process and providing loan financing for them without having any of that compliance and regulatory guidance. So that was one of the first things that jumped out to us. And then at that time, the folks with the Habitat for Humanity of New York, they started to get concerned about it as well, and started to reach out to us and to other banking companies to say, hey, we need to stop handling our own financing. We need to find a way that we can do this, and still be regulatory compliant and not have any issues, or potentially have one of our chapters, brought under additional scrutiny because they were not following any of these regulatory guidelines. So that's what really triggered, the idea here of coming up with a loan product and trying to move it from the chapters over to the mortgage lenders. And Sunny Mae, as all of you know, in the state of New York, they've had a program out there for years, which they are now sunsetting, but they understood that need as well. And that's why they went down the path and created their own product, which has probably been the most heavily used, when you talk about providing financing to anybody from a Habitat for Humanity chapter. So, just wanted to kind of give you guys a little bit of that context as well. So going back to 17, as all this started to develop, that's when myself and other of the founding members and board members, as we said, we started to put together meetings over a couple of months along with Habitat of New York to establish, what could we come up with for a product and a program guideline that then any lender that's a participating lender or a member of the New York Mortgage Bankers Association, we encourage them to take this product, as we said, create your own little version of it, but start offering it because it's beneficial on a multiple fronts, right? If you look at even just at the bottom section there, the real key to this as well was that all these Habitat chapters for years have been using their own money, right? Think about that, so all the tens and hundreds of thousands of dollars that they've used to finance these projects, because they don't always get 100% contributions from all the different members that help out. They've been using their own dollars for this. So, the first, kind of aha moment for them was, hey guys, if you start referring more and more of your Habitat homeowners over to lenders for financing, you're going to save yourself $40, $50, $60, $80,000, whatever it is that they were tying up in a financing arrangement to be able to help that borrower get into that property. So, that was, just a real easy, quick win for all of these chapters that started to go down this path and say, yes, we can now free up that money. And what does that do? That obviously allows that pool of money and more to help them build more homes, right? So, that was a really, really nice development for them as well, as they started to realize they could pivot and move off being not only the developer of the property, but also handling any of the financing that goes along with it. So what we've seen over the past several years as well, and some of you that are on the call may have heard this, or you've had reach out from a local chapter to say, we would like to have a lender from your organization be part of our Habitat chapter, provide financing, help us with maybe pre-qualifications for the borrowers. But would you also handle a loan application or financing for us? So, again, I think this is all going to be the result of this over time, is that more and more lenders will get involved. More and more lenders will create a product like this and offer the financing. And then for the lender benefit, obviously it's multiple, right? Not only are you developing a third-party relationship here, you're developing home ownership. All of these loans are traditionally made to low to moderate income individuals, right? Because that's part of the Habitat criteria. So, when you think about it from a CRA perspective and the loans that you're making, or, where you need some additional volume, you're not doing well in, say, a particular assessment area, there may be a chapter there. That may be an area where a chapter is going to be building 2 or 3 or 4 homes over the next several years. That's going to help also give you opportunity to increase your lending to low to moderate income individuals, or in an LMI census tract, which will help you, with your annual or the 3-year exam that you're going to go through. I think that's a real plus for a lot of lenders as well. So just wanted to give you kind of a little bit more of that background on that context. So what we're going to do here is just kind of walk you through, again, these are all suggestions and these are guidelines. Lenders, as we said, can, choose any of these, duplicate them, use your own version. But, one of the things that we found as we talked amongst this is, several different lenders, we all do something similar in terms of how we try to lay this out. So, when we create a product, you also obviously want to be very specific about, who qualifies and who doesn't, right? So you do that starting off with your eligible property. Now, most of these Habitat builds over the years have been single family homes, but we do know some chapters that look to build 2 units. It's more efficient. They may be able to, get that kind of zoning approved as well. So we just included in there that, eligible properties would be a 1 or 2 unit. Obviously, all these have to be owner occupied. And then again, you want to spell out, what's ineligible, right? If you have any concerns about, what you don't want to offer for financing, just include that in there, and here are some of the things that we put in, properties obviously containing any kind of commercial or industrial usage, unimproved, nobody's typically looking on the residential side anyway, to do any kind of agricultural component lending. Again, in New York City, it may be a little bit different from a cooperative standpoint, but, typically in upstate New York, there's very few, if any, cooperatives anymore, or leaseholds. Most of these chapters are not doing anything larger than we said as a 2-unit property. Most are singles, but, spell that out to make sure your loan originators understand, what's eligible and not eligible. None of these should be non-owner occupied units, right? That's part of the Habitat process, is the home ownership component to it, and the hours and the time that these individuals have to put in themselves to achieve that home ownership of a Habitat home. And then clearly, you don't want a second home component on these, right? You don't want borrowers taking over these properties and then eventually going out and buying something else and trying to retain it as a second home. So, pretty clear what you don't want to finance, but again, it's always good to just spell it out in your product description. Next slide, please. Eligible transactions, purchase. Again, as a lender, you may want to have an option in there, that you'll refinance a Habitat home. There's no reason that you can't or you shouldn't. Borrowers may be in a better financial position at that stage, or they may be eligible for other types of loan products that you offer, or, an affordable version of, a Fannie product or a Freddie product. But again, we created it specific to really address the purchase need that's out there, and to help all these chapters that have houses under construction. We know that they are going to look for financing on those. So, we started it as just purchase, but again, that's an option you may want to look at as a lender. The eligible borrower, again, you want to keep these to that, 80% or less of the HUD area median. So again, important to know, as you talk to the chapters, and you find out where they're building, look at the property address, see where it's located, see if you're going to have that additional benefit that it's being built in an assessment area that offers you, the additional credit that you may receive there for where the property is located. But they're typically all going to be made to eligible borrowers from an LMI perspective. And you want the first-time home buyer typically documented with the past 3 years. We thought that this product, again, following the old rule that Sunny Mae's used forever, right? And most of us use when we create any kind of first-time home buyer product, it's still kind of that 3-year rule, right? As long as they haven't owned anything in the previous 3 years, that's going to be your guideline and still an acceptable criteria as a first-time home buyer. And then typically, we talked initially, do we look at these and offer both fixed rates and ARMs? Do you offer shorter terms? But, again, most of these are going to be first-time home buyers. Best to give them the safest route, which is 30-year amortization, the lower payment possibility and all that goes along with that. But again, as a lender, if you want to offer shorter terms, that's certainly something you could look at yourself. Loan to value, is really key to these, right? And again, some lenders, a lot of us forever have followed the rules, right? When you look at loan to value, you either look at the purchase price or you look at the appraised value, the lower of the two, right? And what we've seen over the years, especially with habitat builds, is, as the industry itself tightened and, we had the supply chain issues and it became more and more difficult, where a property may not be appraising for a little bit less than the actual cost to build now, especially new construction. So again, that's an area that you want to be very clear on and comfortable with. Are you going to be financing if you need to up to 100% of the purchase price of this particular unit? Do you want to go higher than that? Do you want to have any additional grants that may be available to these individuals outside of just their habitat, funding that may be available to them? There's certainly other nonprofit organizations out there that may be offering additional incentives for down payment and closing costs, right? Or just for closing costs. So, build in whatever you want there for your TLTV, but, you certainly want to have a little bit more flexibility and to be able to understand, how high you want to go in terms of either looking at it from a cost to construct an acquisition, or if you want to do it based on the appraised value only. So there's a little bit more flexibility there for lenders. And then when it comes to loan amounts, we all thought, everybody, I think, always likes to have at least a minimum loan amount. And certainly you try to set maximum loan amounts, right? Depending on where you lend, what part of New York State. We know, in the central New York, you can build a house for $150,000. Whereas, in Westchester County, it's going to be, multiples of 5 to 10 times that. So, it really just depends on where your market is and, where you think the sweet spot is for individuals, in the financing that they can afford. But we always thought minimums were good because, again, you're coming up in some cases against high cost loan scenarios, so, how expensive is it going to be when you build in your rate and any fees that you want to charge? You may hit a spot where, it's just going to be too expensive for an individual on the low end side of financing. So as you do with your other products, just kind of give that some thought as well. But set, loan amounts that are realistic for the areas that you want to choose to lend in or the chapters that you're working with. And where they've traditionally financed and the price of the home, that'll drive, kind of your loan amount situation and what you're comfortable with. The other key here is the interest rate, right? So again, one of the things that we learned from the chapters very early on and why they were so reluctant to give up their borrower to a lender for financing is they always used a model where they were not providing an interest rate associated with their transactions that was any higher than 2%. And it didn't matter what the market was. Didn't matter if it was, 40 years ago, back in the early 80s when interest rates were 16 and 18%, or even 3 years ago, when our dear hearts remember when we were all at 2.75 on a 30-year fixed rate, right? So, one of the things that they realized when we started talking about this was, well, if you're going to come over to a lender uses whatever the current market rates are, right? Typically, like today's market, right, where most lenders are out there right now, somewhere in that 6 to 6.5% range on a 30-year fixed. Are you willing to offer a 2% rate? That was going to be very, very difficult for any lender to be able to go to their chief credit officer or chief lending officer and say, I need a 2% interest rate for these borrowers, and here's the reason why. So we went back and forth on that. And what we said was, okay, well, lenders are going to have to make their own decision on how they want to come up with the interest rate offered. But we would think that most lenders would at least offer a discount to whatever their current conforming rates were. And you can justify that because, again, this is affordable housing, right? These are loans specific to low to moderate income individuals. You're trying to set up your product to make it attractive, to make it affordable, to use the terms that they use in the CRA exam. Are you using innovation, and creativity with your lending products? And do you have flexibility built in? So innovative and flexible are two really key components when the examiners come in and look at you from a CRA perspective, when they're looking at the examination and what you're lending and how you're lending and what do your products look like. So, you build in a little bit of that by offering, obviously, some kind of discount below what the current 30-year rate would be in your market. So again, that's only a suggestion. The lower you can go, the more competitive you're going to be, and the more attractive to some of these borrowers. And the Habitat chapters referring them over to you for potential financing with your institution. And then we all thought it was extremely important, right? You have to stay away from secondary market fees, right? These are loans that you're not going to typically sell to Fannie or Freddie, right? They have their own affordable products that they've created, but they may not have as much flexibility as we need for some of these Habitat borrowers. So, we thought that, the fewer fees, if any, that you should be charging these borrowers are going to be advantageous. So, it's up to the lender, if you wanted to charge a quarter point or half a point or even a point, whatever you want to do. But we just felt that, you should not think of it from a secondary market perspective. I've got to sell this loan. If I was selling it to Fannie or Freddie, in this transaction with this borrower based on their income, their credit history, the property appraisal, all of that, you may be normally hitting them with 2 or 2.25 points, right? If you were selling to Fannie or Freddie, you don't need to do that or put that hat on. These are borrowers, right, that you want to treat a little bit more from a affordable perspective and innovative and flexible, as we said. So, we encourage lenders not to include any fees if possible. But again, internal decision there. Next. Down payment requirement, like any first-time homebuyer program, there should be some requirement from the borrower, right? Some of the chapters, as we said, or most of them anyway, still, they don't typically have a dollar requirement for their borrowers that they're going to move into the Habitat family build, but they do require them to put in their own man hours, right? And every chapter is a little bit different, but all of them have a requirement that they have to be involved all through the process of the build of the property itself. So the sweat equity portion is what they kind of build in there. But we felt as lenders, right, the borrowers should still have some type of contribution in when they're coming from mortgage financing. So we just went simply with a $500 contribution, verified out of their own personal funds. And again, you can choose to do something different if you would like. Seller contributions, again, you're basically dealing with the Habitat chapter here. It's not a normal seller or a third-party transaction from that standpoint. But again, a lot of them, not only do they have additional sources to help fund the construction of these particular projects, but they also may have a pool of money. And especially now that they're not going to use a lot of their funds for their own builds and their own financing of these borrowers, they're going to have additional dollars. And maybe they want to use that as an incentive. Some of these chapters may want to use it to help you buy down the interest rate, right? think of it from that standpoint. Again, here's where you're innovative and flexible, and then also creative financing can come into play a little bit here. Maybe they've got an additional, $2,500 or $5,000 that they're willing to use to help buy down the interest rate and get you down a little bit further. So you see where you can really start to get creative here over time. Debt ratio, we felt the 43% as a lot of the market was moving to at that time. You think about it, as Brian said, I'm one of the dinosaurs here. I've been around for 40 years. When I first got into the business, all you knew was two numbers, 28 and 36, right? As a loan originator, the borrowers couldn't spend more than 28% on their housing and no more than 36% when you rolled in their total debt. And we know, over time, as Fannie and Freddie have developed, LPA and DU, those ratios go much higher now. You have borrowers where you can submit it through the automated underwriting. You may get an accept at a 49 back ratio, right? Again, lender choice here. How tight do you want to make the credit box from that standpoint? But you should have some flexibility to have the ability to at least establish a minimum. And if you want to make exceptions above that, certainly, that's your prerogative as well. Next, please. And then score, right? That's always going to be, a conversation. Anytime you have affordable borrowers coming through and, they may not have the most spectacular credit report, right? They're still working on their credit, or they may be rebuilding their credit. So again, up to the lender, what you want to set, but you should always have a minimum credit score. And a lot of the chapters appreciate that, right? Just like the not-for-profit housing organizations appreciate that. They're trying to improve their borrowers, not just through home ownership, but they want them to be better credit borrowers as well. And more borrowers now that have access and follow what their credit score is and get their alerts, right? Everybody's become much more conscious of what their credit score is. So, set a minimum score that you want for the program, build in that flexibility, offer it for a while. If you don't think, you've received enough borrowers from it, you can always go back and adjust it, right? You can always make your product more flexible if you think you need to. But one of the things that we did, before I retired, as Brian said, I was at NBT Bank here in New York for the past 18 years. Regardless of whether this was a portfolio product or whether we were running jumbo mortgages or, you were just basically putting somebody through a conforming, we ran every loan through LPA because we always just wanted to get the automated underwriting feedback as well, right? As you want to just kind of get that sense, if you were trying to package it and sell it, what would it look like? It also helps, maybe pick up a couple of additional things from an underwriting hat perspective. But we encourage any lender to do that as well, even though you're going to typically establish this as a portfolio product, that you're not looking to sell it at any time. You're going to hold this on shelf. You're going to service these borrowers. Still doesn't mean you can't run it through to get any additional, criteria here established. That's also helpful, as you look at these loans, or, that may be important to your chief lending officer, that they want everything run through one of the automated underwriting systems as well. So, we just put that in there. And then clearly you have to have, your non-traditional lending hat on, right? You should always be looking for those three sources, and some of these borrowers may not have that yet, but that's where you're going to look. If they've only got a credit card, then look for your non-traditional, right? You look at your, cell phone bills, look at your car insurance, try to build in at least, three non-traditional sources that can help you with the underwriting perspective to help these folks move along that path. Get your typical documentation in your file. And I think you're going to be good to go from that perspective. You also want to build in, any unacceptable credit, right? Set some criteria in terms of, what's the maximum that you would like to see for any 30-day delinquencies, be it on a credit card, be it on a student loan, whatever it is that you set your criteria for. Set something from a bankruptcy standpoint, because you may see that, right? You always want to have that in there, but again, try to make it a little bit more flexible than you may see from either from secondary market or some investor requirements that you look at as well. Everybody's, looking at medical collections now a little bit differently, again, when we created this back then, everybody wanted written explanations, from the consumers, but again, whatever you want to build in there, certainly something to pay attention to that could be important. Next, please. Flood and hazard, again, extremely important. Not only do we understand that every borrower needs to have, their hazard insurance in place, prior to closing, but, our bank and, I'm sure just about anybody that may be on this call, everybody has become much more specific about flood insurance, right? I don't know of anybody that's waiving flood insurance, regardless of what the borrower says, or even if the chapter says, we're comfortable, that's going to be an additional expense to these homeowners. We understand that, but again, you want to have flood insurance in place. And, from my perspective, and I think when we created this, there should be no waivers for either homeowners or flood. They need to have it. They need to have it in place. You need to be collecting for it. And again, if it's a cost on a first year premium, that's where I go back and then you talk to the chapter and say, hey, borrowers need to come up with X amount of dollars for their flood insurance premium. Would you be willing to give them, a grant for that? That's, again, going back to your creative and innovative and flexible hat, have those conversations. Hopefully you don't run into it too often, but, with climate change that we're all experiencing now, and depending on the territories and where these chapters are building, flood is becoming almost a daily conversation now, right, in all of our shops, and how we handle it. And then set your maximums, right? Because again, the higher you can go on a deductible, the lower that, first year premium and monthly may be for these borrowers. So be conscious of that. But again, you don't want to go too high on that either, because, putting somebody in a situation where they got a $5,000 deductible, and these are first time home buyers with limited funds, and they have an issue 3 months after they're into the house. We don't want to set up anybody for failure either, as you guys know, as lenders. And then again, anything else that you want to build in there for additional requirements, right? Do you want to have comprehensive face-to-face home buyer education, right? Either saying, we're going to partner you up with the local non-for-profit, because again, a lot of these chapters, that's not their expertise, right? They're moving away from any type of financing and counseling, right? They know how to build, they know how to talk to their borrowers, they know how to do the basics of maybe pre-qualification. But, I think we've all seen, and I've seen it in the 40 years I've been doing this, education, first-time home buyers, any borrower that takes education, there's nothing that you can find out there that shows first-time home buyers are more risk to any other borrower that's out there. The benefit of first-time home buyer education, I think, is well documented. Very, very few delinquencies come out of borrowers that are prepared for home ownership. I can confidently state that in all the years I've been doing this. Again, do you want to set up a pre-qual or a pre-approval prior to the start, right? Let's not get too far down the path here. Let's make sure, that we can work out some financing, that everybody's going to be comfortable with it, and you've got that relationship established. And then the Habitat chapter buyback provision, right? So again, this is not something that every chapter has, but as we talk to some of them, and we talk to the folks from Habitat of New York, a lot of these chapters would be willing to put some type of provision, and we're going to talk about that here quickly in a few minutes, in a document that says, should a borrower move down the path and reach a stage, where they run into some financial difficulty, which would be ultimately delinquency and, unfortunately, possibly foreclosure in a situation, would the chapter be willing to step in and buy back that property and turn around and sell it, obviously, to another Habitat borrower that's looking for something and not waiting to build? They could move them right into that house, depending on what it is or if any conditions need to be improved. But that was something that, is important to have that conversation with the chapter as well. Because again, these guys were providing the financing. If the borrowers were delinquent on their payments, they don't have or didn't have the criteria set up that we follow and all lenders follow, very specific to the risk and compliance guidelines that you look for, right? Meaning you're going to be on the phone with the borrower, within 5 days after non-receipt of a payment. Nobody built that in these chapters. A lot of these chapters, they treated these borrowers very, very casually. If they couldn't make their payment for a month or two, it wasn't that big of a deal for them. They knew that they could get back on track, or hope that they could get back on track. But we don't have that flexibility. You guys know that as well, right? We just can't let a borrower go beyond X number of days. Any of the regulators are going to look at us and say, well, what did you do from a mitigation process? And how many times did you speak to these borrowers? And did you provide them with X amount of documents? I can tell you that most of these chapters did nothing like that. And that's another reason why they wanted to move away from financing, because not only the upfront requirements, but also following servicing requirements that are out there from the regulators. That was very loose with the habitat organizations. Next, please. So what we'll end up here is what we did along those lines. And again, we're not sharing all of the information here. This is a multi-page document, but what we thought we had to do, and we felt comfortable, was creating a document here is to give you guys some guidance as well, to be able to have conversations with your habitat chapters. Because as you know, right, if you've got a borrower that's in a delinquent situation, if their mom calls or dad calls or their uncle calls and says, I know my son or my daughter's delinquent on their mortgage, I want to talk to somebody about this. You can't, right? They're not your borrower. It's not a permissible purpose where you've got something set up where you can have conversations and work with a separate individual on a delinquency type of situation. So we felt it was important to have a document created between the lender and the chapter that kind of spells all this out, that says, yes, we understand that this is now going to be a loan that's going to be, to a bank or a lender or an IMB. But we want to be able to have the ability, should the borrower start to experience a delinquent situation, to step in, have conversations with both the lender and with the borrowers to help get these borrowers back on track. Or again, as we just talked about, should it go into a delinquent situation or foreclosure, that we have the provision to be able to step in and buy this property back from the lender, and then turn around and try to sell it to another habitat borrower. So this is what this language is. If you go down to the next slide, please. Again, I'm not going to go line by line here, but we do have this as a separate document. If you're interested, we can send this to you as well. Please reach out to me after this at any time, and I'll talk to you a little bit more and share some more information. But again, we kind of spelled out what's supposed to happen between day 11 to 30, 31 to 60, 75 to 90. This is guidance, and we wanted the chapters to understand that this is how lenders have to work as well. We have very specific regulatory processes that we have to follow, and here's what we can do and how we'll try to communicate with you, Habitat chapter, to help get this borrower back on track. So that was the purpose of creating this additional document, instead of each chapter trying to build it themselves or each lender trying to build it themselves. Next slide, please. Again, a little bit more detail there. And then, as we said, we built in some other sections that cover all those additional pieces. That's okay. You can go to the next slide. What do you have reps and warrants, excuse me, built into this? Indemnification. What if we wanted to just terminate this? We don't want to, refer any borrowers over to the lender. The lender wants to stop offering this product. You build in that termination component to give notification to each other, miscellaneous covenants, anything like that. So each of the attorneys for these chapters, want to review this document. Your internal general counsel, if you create this product, you want them to review it as well, so that when you're ready to offer this to the local chapters, you've got everything ready to go. Here's our product. Here's our, loan servicing agreement and how we're going to treat these customers. If they can't make their payments timely, and then everybody's on the same page as you go forward. So that's our walkthrough there. So just to finish it up, again, in New York and again, anywhere around the country or internationally, Habitat chapters should no longer be handling their own internal financing. They're doing it at their own risk and peril. Because most of what they do, as we said, is non-compliant to what any lender has to follow in both an origination, processing, closing, loan servicing aspect. That's just not rules that those chapters have followed. Lenders should use this as a portfolio product. Again, take that outline, take those guidelines and build your own. But again, we've tried to make it ready-made for you to, make it as painless as possible to put something together, determine what you want to do in your interest rate offering to these borrowers, and then sit down with those chapters and say, hey, we want to help you. We want to take your borrowers. We want to provide financing, and then, understand a little bit more about what they're doing, if they're using anybody now, and what they're looking for from you. And then you build that long-term relationship, because again, it's not just a product here, right? You want to build long-term third-party relationships, as you've done with your realtors, with your builders. You're dealing now with all of that and multiples. A lot of the builders on these projects, as you guys know, work for other home builders, right? They're doing this on their own time. So you've got a lot of opportunity here to take this in a lot of different directions from an affordable standpoint, and we hope you do so going forward. Brian, I'll stop there.
Excellent, Joe. Thank you very much. That is phenomenal. Wonderful framework. Covers origination, underwriting, servicing. And one takeaway I have immediately is that you have seems to be a new partner indefinitely with Habitat as a servicing support. Really, if the borrower falls behind, there's a safety net there with Habitat. Yes. That's very interesting piece of the puzzle. Now we got about 13 minutes left. I know Sherry needs to cover some of the advocacy items, really bullet point items, then you don't want to miss that because it's really critical. And also Jim Bopp had a comment. We brought him up as a speaker. I'm curious, Jim, I'd love to chat with you. There's another opportunity with Habitat and lenders that Jim was looking to bring up.
Sure, go ahead, Jim.
Yeah, I just want to make everybody aware in the NBA's position paper on the pending mortgagee letter on 203K relative to limited 203K and 203K consultants and so on and so forth. We actually put in the letter, suggested that in some areas, possibly Habitat for Humanity offices may have people that I know whoever was at the golf outing at the convention handed me her card. I can't find it, but she was an AIA architect. And in large swaths of New York State, there are no consultants to be had anywhere. Good example would be Binghamton, Elmira. Those markets have zero consultants. It's just a big black hole. So if there are Habitat for Humanity staff that could possibly qualify to become 203K consultants, they could do it either on their own and do it as something to help the community create some housing stock, or I believe they could do it, and if they charged it, they could run the revenue through the nonprofit. So, there's a big focus on getting enough 203K consultants to take existing housing, and in the rural markets, it's a real challenge. For whatever reason, HUD started terminating consultants. They're down from a high water mark of about 2,500 in the country down to about 900 of them. And everybody's looking for an opportunity to find new people who could fill that role. And so it could be Habitat or other nonprofits may have people on staff that do construction. I know Trip at one point, I donated a table saw to them because they had a community tool shed.
Yes.
A lot of these nonprofits have people who work on homes and who understand construction and know budgeting for construction budgets. So keep an eye out for that mortgagee letter. I don't know if HUD is going to expand who can do it. The other people that are being talked about are people like Land Gorilla, Granite Management, Trinity, people like that. It's going to be interesting to see what's going to happen. I would expect that 203K mortgagee letter out within the next 30 days. And it's pretty big sweeping changes to the limited. And the other thing is, if they go to 50,000, the good news is in some rural communities, you could do the limited 203K without a consultant up to 50,000 and work. And the previous cap of 35,000 really doesn't get you as much as it did in 2005 dollars, right? So 50,000 is the new 35. And I think that's where it's I think that's where it's all heading. So,
I hear it.
Thank you,
but it
Jim.
could be a great opportunity for Habitat to have a role, which is their role, to create some good housing stock in the role of a consultant, a construction cost estimators, and really fee service, field service reps. So keep an eye
Right.
out for that. Obviously, when that mortgagee letter comes out, there'll be a lot of scrambling around to adjust to it.
Great.
Thank you, Jim. That's great. It's exactly the type of information sharing and synergy building that we are looking to do with this committee. Appreciate your comments in that space. As there are no other questions in the chat, I'm going to turn this over to Sherry to cover some important items on the legislative front.
Great, thank you. I will just also add, as Jim mentioned, there are other nonprofits like RUPCO, Greater Rochester Housing Partnership, Trip Locally, Long Island Housing Partnership. There's a lot of them that do development. So they'll get donated properties from storm management or tax foreclosure or things like that. And they do their own renovations and resell the properties to owner occupant first-time home buyers. So they have the wheelhouse, the skill set to be able to do this. And most of them do have internal staff. I'll also note that folks that I have been talking to at Habitat indicated that they are working pretty hard to push back on the Sunny May decision to sunset the program. And they're hoping that they'll make some progress through lobbying and legislative pressure to get that program reinstated. So stay tuned to see whether or not they're able to do it. And so with that said, I'll move over to our legislative priorities. As I mentioned at the beginning, thank you. We have our lobby day, March 11th and 12th for anybody that joined a little bit late. And again, the first day is educational, and then there's a networking reception with the legislators that night. And the next day is when we go up on the Hill. We will schedule appointments with as many of your individual legislators as we can, and then fill in with other people that are on critical committees and things like that. So our legislative priorities right now, we're focused on doing things that are going to increase access to homeownership. We want to make sure that that the stuff that we are in support of and advocating for are going to be things that are going to solve problems and not be Band-Aids. So the first thing is the manufactured home titling issue. Most of you are familiar with this. It's particularly an issue in central New York. And so we're working to try to help come up with a better process for the conversion of title from the DMV chattel title over to real property title, which is something that doesn't currently exist. And there is a bill that's been out there for quite some time. We have a new lobbyist, Brown Weinraub, who has been very, very helpful so far in identifying the key players and making sure that we're talking to the right people to be able to get that moving forward. We also, speaking to what Joe was talking about earlier, the value of homebuyer education, also financial literacy in general, is critically important. And the studies that have come out by HUD, by Freddie Mac, indicate that borrowers are 39% less likely to default if they've gone through pre-purchase counseling. The relationship with the counselors is also critical because after closing, if they do find themselves in a bind, they know who they can call for some guidance on what resources might be available to them and how they can work with their servicer. Financial literacy is something that, especially in communities where there's unbanked and underbanked individuals and generational poverty, where they're not generally involved in the banking system at all. People don't understand, for a lot of folks in New York, the banking system consists of taking your paycheck to the corner paycheck person who's going to cash it for you, and that's your money. So there's not credit cards. They don't understand credit scores, how the impact on car insurance and everything else. So financial literacy education is critically important. We're pushing for it in the high school curriculum. Right now, 14 states have mandated this, the most recent being Michigan, and we like their model because the way that they put it forth is that it's a half credit course in high school and can be used to replace any of the 4 math, science, social studies, or English. So that way, if you've got a kid that's, a reader, writer, they could replace math with half a credit of financial literacy. Or if you've got somebody who's going to be a chemist or pre-med or something like that, they can replace English or social studies or something with half, but it's not cutting out a massive chunk across the board of the curriculum. Also, we are looking to implement a first-time homebuyer property tax credit. So the idea, what we're looking at in terms of an iteration of this would be a 1-year abatement of property tax for any first-time home buyers in New York State. What this would do is prevent the borrower from having to do an escrow deposit into a tax escrow at the time of closing, which could save, depending on where in the state you are. I mean, taxes in Long Island on a small 3-bedroom house can be $20,000. So it can be transformative in terms of the cash to close requirements in this state. Now, there are a lot of groups that are focused on this same thing. So Habitat has an iteration, NYSAFA, which is the New York State Association for Affordable Housing. The NeighborWorks groups, there's 16 of them across New York State. That coalition has an iteration. We have one, NYSAR has one. None of the 5 match. So we're also looking to do some coalition building to maybe try to build some consensus. Just to give you a little bit of an idea, the difference is NeighborWorks is pushing for a 5-year abatement where it would be tapered down over time. NYSAFA and Habitat are looking for one that would only be available to folks who have financing that comes along with the regulatory agreement so that they can put a clawback in for the money. And so that would basically put every first-time home buyer who's not doing a Sunny Mae loan or Habitat or some other type of down payment assistance that's got deed restriction and regulatory agreement associated, they wouldn't be eligible for that tax credit. So, you know, we're looking to do some internal coalition building to try to get some consensus so that we can all be fighting for the same thing. Also, we are looking at zoning policy changes for more inclusive zoning. A lot of so New York is the state with the worst underproduction problem in the country for housing. We have way more people than we have housing, and we are not producing it at the rate that our population is continuing to grow or what the need and demand is. So it's critically important that we look at changes at the local level for more inclusive zoning. Things like buildings that are allowed to be more than 2 stories high, density challenges. So there are some groups, one in particular that we've been talking to that Jeff Pinard, the president of the New York NYMBA, introduced us to, called Up for Growth, and they've done a huge amount of research with this on a nationwide level. They're advocating for policy changes at the local level, and they're also trying to educate legislators on the impact of different bills, which is going to be my transition to talking about good cause eviction in just a second. But so we do want to increase access to homeownership. Those are the 4 things that we think are going to have the biggest impact right now. In terms of other things, we need to make sure that we're increasing our inventory. So one of the biggest issues facing us from an inventory perspective is cost of construction. And the cost of construction, as well as access to the construction labor force, are 2 big challenges. The lack of skilled laborers is making construction not only more expensive, but also it's taking a very long time to get things done if you can find anybody who can do the work at all. So we're looking at policies that will incentivize folks to go into the construction labor force, and at programs like BOCES programs or other groups. Big Brothers Big Sisters has programs, but a lot of them are, 14 students every single year or 6 students every single year. So we're looking for things that are scalable or that we can support and look for ways to grow. Also, we're looking at, there is a proposed bill out there to incentivize communities to change their zoning rules to make them more friendly to ADUs. Putting ADUs in properties can help with allowing folks to take care of aging parents. It can also provide access to additional income, making housing more affordable. And obviously those ADU units will increase the number of affordable rental units that are out there for folks. Now, this is something that's been controversial. There are a lot of folks that don't want this to be mandated at the state level because really zoning is a local issue and you want to make sure you retain control. The bill as it's written now provides communities incentives to change their zoning. It's not a mandate. So we are supportive of that and feel that it's something we should look at and see if we can get it it was only introduced in one of the two houses, and I can't remember which, but so that's something we'll be talking about more. And that's also in conjunction with some of the zoning policy recommendations that Up for Growth recommended and groups similar to them. So then the last thing is good cause eviction. So good cause eviction is a bill that passed the Senate. And Christine, if you don't mind flipping to the next slide, please. It last year did not get any real traction in the assembly, but it is an election year. It is something that advocates are already pushing for in assembly and Senate testimony that has been published. So it's something we really need to stay vigilant on. The key provisions are that rent increases of buildings in New York are capped at 1.5 times the CPI or 3% per year. So it's in essence rent control. There's also limits on ending a lease in spite of the terms of the agreement. So basically, what it says is even if you have a 1-year lease that's expiring at the end of 1 year, if the tenant is continuing to pay and hasn't committed any illegal acts or anything like that, you have to allow them to stay there in perpetuity as long as they want to. And in the event that you want to sell the property and somebody wants to put a lot of work into it, so they're going to tell the tenants that they have to leave because they're going to put all this work into it and then they're going to relist the house, that requires court intervention. Any kind of action related to removing the borrower requires court intervention. And also, if you put a significant capital increase, let's say that there is an increase in your flood insurance due to revision on the part of FEMA's flood maps. So you decide that you want to raise the property or you want to move the mechanicals from the basement to the attic so that there's less risk of them being damaged in the event of a flood as an effort to lower your flood insurance premiums. Anything that's going to impact your tenant is going to require a court order. And if you wanted to pass along that additional expense in the form of raised rents, if it's going to exceed that 1.5 times CPI or 3% per year, you have to petition the court in order to make that happen. So I think you can kind of see how this could be problematic in terms of the development of new affordable housing. One other thing that I will say, well, so I'll get into the impact. Relief is going to be hard to get because the courts are already underfunded. And by adding more and more and more burden onto the courts with every one of these little actions requiring court intervention is going to make it nearly impossible for a landlord to be able to do any of these things. So removing a borrower could mean a wait time of 18 months to get things done through court. And there are set steps that they have to follow before they can even file anything in court. Then there's also evidence that there would be a lack of secondary financing for these buildings going forward. So as a key case study, when you look at Signature Bank and the way that the assets have been handled post the collapse of Signature Bank, there were $13 billion worth of assets that were secured by properties that are rent controlled. And these properties and these assets are not considered to have any value by the secondary market, as noted by the fact that they're still under conservatorship of the FDIC. No, all of the rest of the assets of Signature Bank were picked up by other banks. Everything was purchased off or sold off, except for these. And so if we don't have banks willing to lend for the development of the housing because they don't see these assets as having value, that is going to be problematic in terms of exacerbating what is already the nation's worst underproduction of housing issue. Then there's also the fact that statistically, rent-controlled properties have lower quality ratings. They have more building code violations. There are more health and safety issues reported and found to be sustained. So we are basically dooming people who are in the current housing to be in lower quality, not well-maintained housing, while basically excluding everyone coming up behind them who aren't going to be able to find any affordable housing at all. And so the end result of all of these different factors will be a significant decrease in the production of new housing. And obviously that's not what we're going for. What we're going for is to increase the production of housing. So the answer to this, and when you talk to advocates, what the problem is there are bad actors out there. So there are landlords that say, we're going to raise rent because we can. And I'll just give you an example. There's 2 apartment complexes that are right across the street from each other in Cohoes. One of them has on average annually raised their rent more than 15%. A new apartment complex got built across the street. So one year, while that first complex was filling up, the new one, a lot of folks, when they did this massive 15% increase in the one across the street, moved. Well, now they're both full. So now they're both increasing rents, in excess. A friend of mine that lives in there just got a 21% increase in their rent. Obviously, that makes it extremely difficult from a stability perspective. It makes it very difficult for kids that are in schools. And when somebody's getting displaced because now their housing is no longer affordable, then there's no new affordable housing for them to go to in that market. And so they find themselves in a position where to relocate, that puts them in a necessity to change school districts, which could mean that there's going to be more problems in terms of the parents' employment. I mean, if your child is now in a different school district, you might have to deal with transportation issues. You might have commuting problems. I mean, so it can cause upheaval in people's entire life. So 2 things to this. One, that's why increased access of home ownership is critically important, because home ownership provides stability that's very much needed for folks, but also it underlines the need to continue to build more affordable housing so that these folks have competition and places to go, and getting priced out of a specific building is going to be a situation where those landlords aren't going to be able to get away with doing that anymore, because if people have other places to go, then they're not going to have any tenants. So it's going to force them back in line through the competitive pressure of the market. So it's really critically important that what we do is focus more and more on the creation of supply, and making sure that there's access to more and more affordable housing, so that these bad actors can't get away with what they're doing. And also so that we don't have Band-Aid, unresearched, emotional things that sound good because of the way that they're labeled, passing, that would have catastrophic impact on the housing supply in our state. So it's critically important that we participate in these advocacy days, that we go in with facts, figures, and real data that's going to be persuasive to the legislators about really what the unintended consequences of passing a bill like this are going to be. And that the better way to solve this problem of these bad actor landlords is through competitive pressure in the market, and giving borrowers more options to be able to get away from those bad actors. So we will, the Jim Bott made a comment that these advocacy topics point to the reason why New York State is #1 in terms of migration out of the state. I would say there's probably a lot of reasons why that's happening, but certainly this is a contributory factor. If people can't find an affordable place to live, they're going to go live somewhere else. And frankly, a lot of the developers that I've spoken to have said the same thing. Instead of developing in downstate New York or in New York City, they're going to go over the line to Connecticut, to New Jersey, to Pennsylvania, to Massachusetts, to Vermont. It doesn't really make any sense for them to be developing rental properties in New York State if they're going to be subject to these basically draconian restrictions. So, the strategy here is to make sure that we're continuing to focus on effective, good, positive policy that's going to have the same impact that they're hoping to get out of the bad policy, so that not only are we going in and saying this is terrible and here are all the reasons why, but also saying, and here are the things we think will get you to that same end and that same solution. So again, we are working really hard on building coalitions and doing direct outreach to the advocates, because a lot of them, when you have conversations, they don't understand the unintended consequences. So if we can talk to them and get them to a point where they're on board with some of these other things and they're advocating for the good policy instead of the bad, then we have less risk of dealing with what the fallout of this passing would be. So I really hope you will join. And there are other bills. So to say, I picked this one because this one is the biggest threat to us right now. And I also see it as our best opportunity, just based off of the conversation. We do have a really good opportunity to stop this from happening. So if we're looking to put our capital where we think we could have an impact, this would be not only hugely impactful in preventing disastrous policy, but also something that I think we actually can prevent.
Excellent. Thank you, Sherry. That is phenomenal. And please stay engaged with us on this. There's a lot of stuff that's happening in New York State, and to Jim's point, it's market disruptive stuff. And we got to push back on that, and we're going to do that with our advocacy efforts coming up soon. So stay tuned. Joe Culver, thank you very much. That was a fantastic presentation. Enlightening. If you're looking to implement some of these ideas or the NYMBA Habitat program, please reach out to us. Members would have access to all the due diligence, all the research, all the ready-made, I don't want to say turnkey because there's a lot of customization you can do to the program, but it really is, in essence, a turnkey special product that you can offer that's CRA credit eligible for the Habitat folks and potentially other organizations too.
Yes.
So thank you, Joe. This is very important stuff and timely considering what's going on with Sunny May. Jim Bopp, I appreciate your comments. Thank you very much. And with that, thank you all for being here today. Mark your calendar and join us for the next Affordable Friday webinar scheduled for February 16th, 2024. With that, have a great rest.
Actually, I'm just going to add real quick. We have Mary Kay Scully as our speaker for February. She's phenomenal, really excellent. And her presentation is on how to navigate the barriers that your borrowers are bumping up against. So if their credit score is low, some tips. How do you help them get access to the cash they need? So it's really going to be a great thing for loan officers that are looking for strategies to help their borrowers who aren't quite home ownership ready get there.
And if any of you know Mary Kay Scully, it's going to be a blast.
Yeah.
Thanks, everybody.